Welcome to the Deep Dive. Today we're doing a really focused journalistic report, basically digging into the financial and credit services sector.
That's right. We've used a stock screener and pulled out the top 3 performers.
Yeah, the big names that popped up are SoFi Technologies, PayPal, and Capital One. So our mission is to really break down the data for you.
We'll look at valuation, technical signals, what the charts are saying, recent news.
And give you that kind of complete picture of what's driving these specific companies.
And it's interesting, right? Because these top 3, they show such a wide range within the sector.
How so?
Well, you've got SoFi and PayPal, kind of representing the newer fintech digital side.
Right, the tech platforms.
Exactly. And then you have Capital One, much more of a traditional established institution. So it's a neat snapshot.
Okay, so that's a great way to frame it. So here's how we'll tackle it. We'll go stock by stock, basics first, then the technicals, buy-sell triggers maybe.
We can look at what the charts suggest, yeah, and the key news items.
And then the fun part, our paper money game. We'll imagine investing, say, $5,000 in each one exactly a year ago.
And see where that hypothetical investment would stand today. Calculate the profit or loss.
Perfect. Should be insightful.
Definitely. Just one quick but important point before we jump in.
Sure.
Everything we discuss here, it's purely for informational and educational purposes. It's analysis, not advice.
Right. Not investment recommendations. Always do your own homework.
Precisely. Okay, ready to dive in?
Let's do it. Starting with the one that feels like it has all the buzz right now.
Yeah.
SoFi Technologies, ticker SOFI.
Yep, SoFi on the NASDAQ. Market cap is pretty substantial now, around $32.23 billion.
And remind us, what's their main business? It's kind of spread out, right?
It is. They break it down into 3 main segments. Lending is a big one, obviously. Then there's their technology platform, which includes Galileo.
Ah, Galileo, right. That powers other fintechs.
Exactly. It's a key piece. And the third part is their broader financial services offering.
Okay, so looking at valuation. Wow. That PE ratio, the trailing one, is 54.84. That's high.
It is high, no question. I mean, that number alone would scare off a lot of traditional value investors.
So why is the market seemingly okay with paying that much?
It really comes down to the forward look, the expectations. Analysts are forecasting, believe it or not, over 78% EPS growth next year.
78%. Okay, that explains the premium then. They're betting big on future earnings.
Hugely. And you can see why when you look at recent performance.
Like what?
Well, the earnings per share growth, quarter over quarter, it was an incredible 1,000%.
1,000.
Seriously. And sales growth Q over Q was also strong, over 31%.
Okay, those are explosive numbers.
Yeah.
But what's the catch? There's got to be risk baked in there somewhere.
Oh, absolutely. The risk is volatility. Look at its beta.
Beta. That measures how much it swings compared to the market, right?
Exactly. SoFi's beta is 1.93. So historically, it's almost twice as volatile as the S&P 500.
So big potential upside, but also big potential downside swings. High risk, high reward.
That's the textbook definition for SoFi right now.
All right, let's look at the technicals. The price chart, currently $27.19. How's it look?
The momentum is just, well, undeniable. The price is way above its long-term trend line, the 200-day moving average.
How far above?
Over 50% above, 50.76% to be precise. That signals a very strong, sustained uptrend.
What about shorter term? Any signs of slowing down?
Interestingly, the 20-day moving average, the SMA 20, is just slightly below the current price by about negative 0.22%.
So maybe a little pullback or consolidation very recently.
Exactly. Could be seen as a brief pause in that bigger uptrend, maybe a potential entry point for some traders, technically speaking.
And what about the news? What's driving this optimism?
A lot of positive sentiment. Sources we looked at mentioned a strong bull case theory for SoFi, focusing on its long-term potential to scale.
This is just about lending growth.
Not entirely. There's a lot of focus on efficiency gains through tech, like using AI. One source mentioned Connecta's AI advantage helping companies like SoFi. So it's the tech platform story, too.
And I saw that headline. Pretty bold prediction.
Oh, yeah, the one saying, oh, SoFi will be worth more than Capital One by 2030.
That's the one.
Talk about bullish.
It definitely captures the market's high hopes for SoFi.
Okay, let's put some numbers on that hope with our paper money simulation. $5,000 invested 1 year ago. The stock's up a massive 167.09% over the year.
Right. So based on that 167% gain, if you invested a year ago, the entry price would have been roughly $10.18 per share.
1018. So for $5,000, how many shares is that?
Let's see, $5,000 divided by $10.18. That gets you about 491 shares, just over 491.
Okay, 491 shares bought at $10.18. Now the price is $27.19. What's that worth?
Those 491 shares at today's price comes out to an estimated $13,358.29.
Wow. So that initial $5,000 turned into over $13,000.
Yep, that's a paper profit of $8,358.29. You basically captured that full 167% return. That perfectly illustrates the potential payoff from riding a high-growth, high-volatility wave. Amazing return.
But definitely not for the faint of heart, given that beta.
Understood. Okay, so LFI represents that hyper-growth, tech-fueled optimism. What about a company that's maybe past that initial explosive phase?
Good transition. Let's look at PayPal Holdings, ticker PYPL.
A household name.
Yeah.
Much bigger company too, right? Market cap?
Yeah, significantly larger. $65.03 billion market cap. Listed on NASDAQ, part of the S&P 500 and NASDAQ 100.
Core business is digital payments, PayPal itself, Venmo, Zoom, Braintree. They're huge in that space.
Absolutely. First-generation digital payment giant. But the story here, valuation-wise, is almost the opposite of SoFi.
How so? Looks cheaper.
Much cheaper, at least on paper. The trailing PE is only 14.57, and the forward PE is even lower at 11.72. PEG ratio is around 1.19.
Okay, that looks attractive based on earnings.
Yeah.
And are the underlying financials solid?
They actually look quite strong. Profitability metrics are good. Return on equity, ROE, is impressive at 22.92%.
23% ROE. That's solid.
And a profit margin close to 15%. So it looks like a profitable, reasonably valued company. No dividend, though.
But, and there's always a but, the stock performance over the last year has been terrible, down almost 16%, negative 15.9%.
Exactly. That's the puzzle.
So why the disconnect? Good profits, decent valuation, but the stock's sinking. What gives?
Well, I think it boils down to technical weakness and the competitive landscape. The chart tells a pretty clear story.
What are the technicals saying?
It's not kiddie. The current price, $68.07, is trading below all the key moving averages.
Below the 20-day, the 50-day, and the 200-day?
Yep. SMA 20 is negative 2.06% below, SMA 50 is negative 1.25% below, and the long-term SMA 200 is over 5% below. That signals a persistent downtrend.
Ouch. What about momentum indicators like RSI?
The RSI is at 46.95. Generally, below 50 suggests bearish momentum is still in control, so technically it looks weak.
And the news hasn't helped, I imagine.
Not at all. There was that Goldman Sachs downgrade recently cut the stock to sell.
Why? What was their reasoning?
Citing margin pressure, and that really hits on the core issue.
Competition.
Intense competition. From Apple Pay, Google Pay, all the integrated mobile options, plus challenges in really monetizing Venmo effectively to meet growth expectations. The market seems worried the growth story has stalled.
And wasn't there some weird news about their stablecoin?
Oh, right. That was bizarre. Their partner, Paxos, accidentally minted something like $300 trillion worth of the PayPal stablecoin, PYUSD.
300 trillion. How does that even happen?
Apparently it was a testing error. They burned it immediately, but still, it doesn't exactly inspire confidence in operational controls when things like that slip through.
Yeah, not a great look. And executive changes, too.
Right. The former CEO, Dan Schulman, left, and he's now been appointed CEO over at Verizon. So some leadership transition happening as well. All adds to the uncertainty.
Okay, let's quantify that negative sentiment with the paper money test. $5,000 invested a year ago, but this time it's against that negative 15.90% performance.
All right. With a 15.90% decline over the year, the entry price 1 year ago would have been higher, around $80.95 per share.
$80.95. So $5,000 would have bought fewer shares.
Correct. About 61.77 shares. Let's call it 62 shares, roughly.
And today, at $68.07 per share.
Okay.
What's that worth?
Those 61.77 shares are now valued at an estimated $4,204.60.
So a loss.
Yep. A paper loss of $795.40 on that initial $5,000 shows that even strong profitability doesn't save a stock if the market loses faith in its growth path and the technicals turn sour.
A tough lesson for PayPal holders over the past year. Okay, we've seen hyper-growth with SoFi and a maturing giant facing headwinds with PayPal. Let's move to the third one.
The traditional powerhouse, Capital One Financial, ticker COF.
COF and the NYSE, also S&P 500. And this was the biggest of the three, right?
By far. Market cap around $140.94 billion. Core business is what you'd expect. Credit cards, consumer banking, commercial banking, very established.
Okay, now the valuation here looks confusing.
It really does. This one requires a bit more unpacking. Look at the PE ratios.
The trailing PE is 113.48. That seems astronomically high, especially for a bank.
Exactly. It reflects some recent struggles, including a reported negative net income figure, Hanaker $301 million, not too long ago. That makes the trailing earnings look terrible, hence the high PE.
Negative net income. But wait, the forward PE is 10.76.
Precisely. That's the key divergence, from 113 looking back to just under 11 looking forward.
So analysts expect a massive, almost unbelievable turnaround in earnings. How can they justify that, given recent negative income?
It strongly suggests Wall Street sees that negative income period as a temporary blip, maybe due to setting aside large amounts for potential loan losses or some one-off restructuring costs, perhaps related to the Discover deal integration.
The Discover acquisition.
Right. They expect earnings to normalize very quickly and significantly, making the stock look cheap on a forward basis. And that expectation seems to be driving the stock price.
Which has done well over the last year.
Very well, up 38.58%, a solid gain.
So the market is buying into that turnaround story. What did the technicals show?
Technicals look strong, confirming the bullish sentiment. The stock's at $220.38. It's trading comfortably above its 20-day, 50-day, and 200-day moving averages.
All bullish signals. How far off its highs?
Only about 5% off its 52-week high. And the RSI is healthy, around 55. So the chart supports the idea of market confidence.
What were the big news catalysts driving this, beyond just the forward guidance?
The Q3 earnings report was a big one. It beat expectations, but arguably even more important was the announcement alongside it.
Where was it?
A massive $16 billion share buyback program.
$16 billion, that's huge.
It's a very significant signal for management. It says they believe their own stock is undervalued despite the messy trailing numbers, and they're putting serious capital behind that belief.
That definitely sends a strong message. And what about analysts?
Generally positive. The average target price is up around $260. We saw recent upgrades like Rothschild & Co. Redburn initiating with a buy rating and a $290 target. So the narrative is definitely leaning positive, powered by that buyback and the expected earnings recovery.
Okay, final paper money run. $5,000 into COF a year ago, capturing that 38.58% gain.
All right. Based on that 38.58% performance, the entry price 1 year ago would have been approximately $159.09 per share.
$159.09. So $5,000 gets you.
About 31.43 shares, let's say 31.5 shares.
And today at $220.38.
Those shares are worth an estimated $6,926.39.
Nice. So a solid profit there.
Yep, a paper profit of $1,926.39. A very healthy return. Not the explosive gain of SoFi, but much better than the loss on PayPal, and shows the power of a recovery story backed by corporate action.
Okay, let's try and synthesize this. 3 stocks, same sector, very different journeys over the last year, based on our $5,000 hypothetical.
It really tells a tale, doesn't it?
Yeah.
SoFi was the clear winner in terms of pure return. That 5.8 turned into over $13,300, a profit of $8,358. That's the reward for betting on that high-growth, tech-driven, high-beta story.
Huge volatility, but huge returns if you timed it right. Then you get Capital One.
Oh. COF delivered the steady, solid gain. Almost $2,000 profit, $1,926. Driven less by current results and more by that massive expected earnings jump, the low forward PE, and crucially, that huge $16 billion buyback signaling management confidence.
It shows how forward guidance and big corporate moves can completely change the narrative, even with poor recent numbers.
Absolutely. And then there was PayPal.
The unfortunate loser in this trio. Despite having decent underlying profitability, strong ROE.
The negative sentiment, the competitive worries, and the really weak technical picture trading below all those moving averages led to a loss of nearly $895.
So the key takeaway seems to be that in this sector, like many others, future expectations and competitive positioning can often outweigh current profitability in the market's eyes.
I think that's fair, and it highlights the different risk profiles available just within the top performers of one sector, from hypergrowth speculation to value recovery plays.
Fascinating stuff. Now, you mentioned something earlier about Capital One that ties into a final thought.
Ah, right. It connects back to that $16 billion buyback and the recent news flow. While COF is spending billions to boost shareholder value through buybacks.
Yeah.
Our sources also noted recent news about COF implementing layoffs, specifically impacting the former Discover headquarters after the acquisition.
Okay, so buying back stock, but also cutting jobs.
Exactly. Which leads to a provocative question for you, the listener, to think about. If a company is aggressively managing costs through layoffs while simultaneously deploying massive amounts of capital to mechanically lift its stock price via buybacks, how sustainable is that approach for delivering the actual long-term operational performance and profitability implied by that super low forward PE of 10.76? Is the buyback masking underlying challenges, or is it smart capital allocation alongside necessary restructuring?
That's a really interesting tension. Balancing shareholder returns today with long-term operational health and achieving those big future earnings targets. Something to definitely chew on.
Food for thought.
Indeed. Well, thank you for walking us through the data and sharing your sources for this deep dive. Really insightful.
My pleasure. Always interesting to see the stories the numbers tell.